Wouldn't it be great to take a $100,000 loan with 0% interest, invest it for as long as you own the property, and then when you sell the property, you give the loan amount back and you keep whatever you made on that investment?
I'm Jason Hull, CEO and founder of DoorGrow, the world's leading and most comprehensive coaching and consulting firm for long-term residential property management entrepreneurs. My guest today is Dan Boyd. We're going to talk about cost segregation, one of the most powerful ways to uncover hidden tax savings for property owners and managers. You'll learn how to accelerate depreciation, apply repair regulations, and know when expenses can be written off immediately. These strategies can help you improve client cash flow, strengthen relationships, and stand out in the market. So Dan, before we get into cost segregation, which is an interesting subject, tell us, how did you get connected to this business?
Sure. Yeah, it's a
Give
little
us some
funny.
backstory on Dan.
You bet. I meet people from time to time and they say, how on earth did you get into this line of work? Because it's not like anybody goes to school to work in cost segregation, or at least cost segregation sales. And, tale as old as time, I knew somebody. And so I was working in the nonprofit sector. My goal was to become a superintendent. So I had gotten a doctorate in education and I was headed in the right direction. But I found out that the average superintendent lasts for about 2 years. I thought, why don't I just skip those 2 years and go into sales and consulting? And so somebody had told me, I think you'd be pretty good at this. And so I started selling cost segregation for our company. And then there was an opportunity. They said, we needed to improve our training and our education. And you've got the perfect background. You understand what we do, but you also come from a world of education. So why don't you join us in that capacity? And so it's been a very good fit since then.
So cost segregation, how do we uncover some hidden tax savings?
So the big idea here is there's things in a property that wear out fast, and there's things in a property that wear out slow. But how do you know? And that's where we come in. So our job is to tell you, with our knowledge of the IRS code and buildings, that's what makes us unique. We're very good at both of those things. What's the value of everything in your property that wears out quickly? Once you know that, you get to write it off quickly. So let's say you buy an apartment building for $1 million. Ordinarily, you're going to depreciate that whole building over 27 and a half years. Well, there's components in that property that are going to last 3 years, 5 years, 7 years. So shouldn't you be able to write it off sooner? And the answer is yes. And that was actually, there's a landmark court case that led to this. And that was the big argument was, hey, we replace some of these components every 5 years. You're making us wait 39 years because it's a commercial property to depreciate it. And the court ruled in their favor and said, you're right. And so our job is to come in and really give somebody a huge deduction in the first year. Sometimes 25, 30, 40% of the building value can be deducted in as quickly as the first year.
So what are the steps to making that happen?
So first thing is assuming this makes sense, right? You got to owe taxes and you need to hold your building for at least a couple years. And I can get into why, but if you wanted to see, does this make sense for me? Just get an estimate. So find a reputable firm to work with that does engineering-based cost segregation, and they'll send you an estimate. And they'll say, hey, we think you're going to get somewhere between these two numbers, right? And that's a high and a low end. And so in general, that's 25% of the what we call the building value. So subtract land out, right? Now you're just left with the building on that lot. That's what you get to depreciate. So if you've got an $800,000 building, maybe you paid $1 million, land is worth $200,000, subtract that out. So you got $800,000. And again, you'll get a range saying, maybe you'll get somewhere between $180,000 up to $300,000 in depreciation. If you like the way that looks, the fee makes sense, and you owe taxes and you can use it this year, then you proceed with that cost segregation study. And usually I would say with our firm, within 2 to 4 weeks, we give somebody a report. So we make it very simple. Right? That report justifies the big deduction. So if somebody ever got audited, which is a pretty rare occurrence anyway, they would be able to explain, here's why we did this. This is legitimate. We worked with a firm that has real engineers that did this. And it gives the CPA what they need. CPA is not just going to say, okay, yeah, I'm going to give you a $200,000 deduction for fun. They have to feel comfortable because their signature is going on it. So it's our report that demonstrates to the CPA and to the IRS, this is a legitimate deduction within the tax code, and this will stand up to an audit.
So your company helps with this, right? CSSI.
Yes.
Okay, got it. Okay, so Are there different rules? I thought some rules had kind of changed with depreciation and how it works just recently.
Yeah. So in this most recent One Big Beautiful Bill, there was a change that brought back what's called 100% bonus depreciation. So what does that mean? There's some misunderstandings, and sometimes people assume that means you can deduct 100% of the building value. That's not the case. So I said there's stuff in a property that wears out fast, and there's stuff that wears out slow. So the IRS has categories for that they call useful lives. So there's probably the most common categories that property managers are going to need to be aware of are the 5-year useful life. And that's roughly the stuff inside the units. And then there's the 15-year useful life. That's the site improvements. So that's a parking lot, that's landscaping, that's signage, that's a fence, that's a pool, those kind of things. The things on the common ground, right?
Okay.
So what that means is if something has a 5-year useful life, you depreciate it over 5 years. So automatically that's faster than 27 and a half. So that's accelerated depreciation because we accelerated it from 27 and a half years to 5 years and from 27 and a half to 15 years. Bonus depreciation lights a fire underneath those two categories. And so rather than waiting 5 years or 15 years, you get some percent of that value right now. So if we're in a 100% bonus year, it means you get 100% of the 5-year value and 100% of the 15-year value right away. And so if we just say, cabinets, countertops, crown molding, that kind of thing, swimming pools, parking lots, that's all going to be accelerated. So if you had $500,000 in those two categories, rather than waiting 5 years or 15 years to get that money, you bonus depreciate it and get all of it this year. We just came out of what's called a sunsetting bonus period. And so from 2017 to 2022, people got 100% bonus depreciation. So if your property was placed in service as a rental in those years, it gets 100% bonus, period. Doesn't matter when you do the cost segregation. But in 2023, it started to go down 20%. So 2023 was an 80% bonus year. 2024 was a 60% bonus year. And the first 19 days of 2025 are a 40% bonus year. So 100% bonus depreciation kicks in on inauguration day. So they made it retroactive to the inauguration day. So if you bought a property and placed it in service on January 20th or later, you get 100% bonus depreciation.
Cool. Thank you, Donald. All right. So why should investors that are wanting to invest more care about cost segregation?
So the time value of money. If I could give you $100 today or $1 a day for the next 100 years, it's worth way more to you to get that money today because you can invest it, right? There's no inflation, yada, yada, yada. So the more tax deductions or reductions you can get early on, the more you're able to free up your capital and deploy it to grow your portfolio, right? To repair your property, to increase rent, to pay down debt. And that money is worth a lot more to you today. So if you can get 25% of your building value back now, rather than in a quarter century, why wouldn't you do that?
Got it. Let's do a quick word from our sponsor, CoverPest, and then we'll continue. CoverPest is the easy and seamless way to add on demand pest control to your resident benefits package for your property management company. Residents love the simplicity of submitting a service request and how affordable it is compared to traditional pest control options. Investors love knowing that their property is kept pest-free, and property managers love getting their time back and making more revenue per door. Simply put, CoverPest is the easiest way to handle pest control issues at all your properties. To learn more and to get special DoorGrow pricing, visit coverpest.com/DoorGrow. All right, cool. Check out CoverPest. All right, so back to this idea of investors leveraging cost segregation. So this is going to allow them basically more money now means you can take that money, deploy it in more effective ways now to grow it so you can have more of it later, right?
Yeah, absolutely. If you owe taxes right now and you own rental property, as long as you're going to hold that property for even just 2 or 3 years, you are going to make more money by taking more depreciation, reducing your tax burden, freeing up capital to reinvest and make some rate of return. And so as long as you can invest that money and earn a return, then you're going to benefit from doing this.
Same reason I file an extension every year. I want to delay the IRS having access to any of the funds so that I can do more stuff with it before they get their hands on it.
There you
right?
go.
So more money faster and IRS later. Yeah, that's the ideal goal. Cool. So how do they make sure that they're making good decisions around all of this? This is where a company like CSSI comes in, I would imagine.
Yes. So we see ourselves as consultants. And so our job is to look at somebody's scenario and say, right, here's what we think your deduction will be. Let's match that up with what's your tax liability, right? Do you owe a lot this year? Or maybe are you going to owe next year? Should you wait? And then how long are you going to own this property? Let's do the math and figure out, does this investment make sense? And so that's kind of the big one. Like my two litmus tests are, do you owe taxes? And are you going to own this property long enough to invest this? And the reason for that is when you take depreciation on a property, whatever you take out, you owe back when you sell the property. That's called recapture. And so oftentimes people are afraid of that. But I think the best way to think of that is like a loan, right? The IRS loans you that depreciation. And then when you sell the property, you owe the depreciation back. But they don't charge you interest on that. And so wouldn't it be great to take a $100,000 loan with 0% interest, invest it for as long as you own the property, and then when you sell the property, you give the loan amount back and you keep whatever you made on that investment? It depends on your rate of return. So, if I give somebody, let's say $100,000 and they can make 7.5%, as long as they pay less than $7,500 to get the cost segregation study, they're going to make money. And so that's usually how I do that math. And it's different for everybody. And sometimes they're not sure. And so I'll kind of walk them through. And my tendency is to be a little cautious with it and say, if you're not sure, I don't want you to get into a situation where you're going to end up owing more than you got in terms of your reduction in taxes and any benefit out of this. But I'd say a very comfortable break-even period is 3 years.
Got it. Okay. So if they own it for at least 3 years, then it may make sense. They should pay owe taxes and they haven't figured out how to zero those out. Right. And if you're a decent investor, you could probably do something with that money, like grow it over the next 3 years.
Yeah, absolutely. And that example I used, getting $100,000 in tax savings back for $7,500, it may cost less than $7,500.
So it could be a no-brainer, but you'll help them see that.
Absolutely.
Which makes it probably a very easy product to sell to the right person. So what are the other big questions that people ask you when you are selling these services?
Great question. So the big one is, am I going to get in trouble with the IRS? And the answer there is no. So this is no more risky than even just, let's say, not cost segregation. So our company's done in the ballpark of 55,000 studies, and we have not seen that this triggers an audit. And when the IRS asks to take a second look, they're usually just, that's part of due diligence. And so they don't reject the results. They don't have penalties or anything like that. So it's pretty rare that somebody would even get an audit when they have a cost segregation done. The other, I would say, like a typical safety concern, right, is people say, well, that's my CPA's job, right? They do that. And a CPA, kind of depending on who your CPA is and how they operate, you might say it's not really their job to look for business strategies for you, right? Ways that you can deploy capital and invest it. They're preparing your taxes, right? That's really what they're allowed to do. So, and I think people often make that mistake of thinking that their CPA is their business coach. And plain and simple, they are not, unless you're paying them a lot of money to do that. And so we work with a lot of CPAs who do that type of consulting and work, and they refer their clients to us because this is not something a CPA can do, because you've got to have an engineering background. And so unless your CPA went to school first to be an engineer and then a CPA, this is not in their wheelhouse. And if their firm offers it, they're probably just working with a firm like ours and saying, okay, we'll pay for the study and then we'll give it or sell it to our client.
Yeah. From my experience, your accountant or your CPA is not a tax professional. They play it super safe. They are not trying to do anything related to lowering your tax dollars.
Yeah.
So I would recommend anybody listening, if you have a CPA, awesome. And I highly recommend you go, if you're a business owner, get a Profit First certified professional. I think that's a good early stage step to making sure you have financial health in your business. They're going to take things a little bit beyond just standard accounting, but go find a tax expert that's going to help you with tax stuff. And then you're going to need probably experts like CSSI. Did we miss anything that you think would be important for the audience to know about cost segregation?
So why would, like, to your audience, why does this matter? And I'd say, if your clients don't hear about it from you, they're going to wonder why. They're going to think, I trust this person with real estate. I would have expected them to know about this. And so
they are expecting you to be the investment specialist.
Yes.
That's where you set yourself head and shoulders above just being a property manager, where you're just like, a commoditized service. Then you're at that next rung on the ladder where you're an advisor, you're a consultant, they appreciate you. So property managers could be leveraging CSSI. How can they leverage you guys?
So a really easy way to get in touch with us is you can just go to our website, and there's a calculator there. And I think actually this would be even better. I think we have a landing page specially for DoorGrow listeners, so people can go there and you can get information about a property. So if you want information for a client, you could go there and you could submit a request, and we will send you an estimate for that client, that property, with a discount for DoorGrow listeners. And so, there we go. So that's CSSI Services.com/DoorGrow. And we'll make sure to walk you through it, help you understand how you can talk to your clients about this so that you come across as the expert, right? We don't need to take center stage. We want to help you be the expert and really deliver the great news to your clients. And again, if they hear this from you, they're going to say, that's why I work with this person. I work with them because they're looking out for me. They have my best interest in mind.
Yeah, they're expecting you to be the investment specialist.
No harm to getting that, presenting it to somebody. And that way, even if they
Got it. And so the property manager could initiate this process for each of their properties. Okay, got it. Very cool. Well, Dan, I appreciate you coming on the show. All right. So if you've ever felt stuck or stagnant in your property management business and you want to take it to the next level, reach out to us at DoorGrow.com. Also, join our free Facebook community. It is just for property management business owners at DoorGrowClub.com. And if you would like to get the best ideas in property management, join our newsletter by going to DoorGrow.com/subscribe. And if you found this episode even a little bit helpful, don't forget to subscribe and leave us a review or a positive comment on whatever channel that you saw or heard this on. We'd really appreciate it. And until next time, remember, the slowest path to growth is to do it alone. So let's grow together. Bye, everyone.